All right, let's unlock these investing secrets. We're diving deep into, well, a classic, Benjamin Graham's The Intelligent Investor. And you know what? This one's custom made, just for you. We're using your copy of the book and those awesome notes you sent.
Smart move. Adding the interpretation of financial statements shows you're thinking ahead, looking for that deeper understanding. That's what Graham was all about. Not just picking stocks, but that whole mindset, that philosophy, to navigate those wild markets.
It's interesting, right? Before Graham, investing was kind of like the Wild West, secret society. Zweig even points it out. It was all speculation and wild swings.
Imagine it like a saloon, right? Smoke and mirrors, the whole bit. Investors were betting on rumors, gut feelings, no real clue what they were buying. Then Graham walks in, like the sheriff, laying down the law, bringing logic, analysis, the whole 9 yards.
So pre-Graham, you were basically, gambling with your money.
Basically, yeah. That's why security analysis was such a game changer. It's like the first investing textbook ever, laying out those principles, how to evaluate a business, separating the real deal from the hype.
Okay, so how did he develop this revolutionary approach? Was he, born a stock-picking whiz?
Not quite. He had some pretty dramatic early experiences. Take Savold Tire, 1919.
Yeah, Zweig mentions that. A 250% return on day one. You'd think he hit the jackpot.
Beginner's luck, right. But there's a twist. By October, that same year, Savold Tire, worthless. Total fraud.
Ouch. Talk about a harsh reality check.
A wake-up call. It showed him, right, that the market's irrational in the short term and hype can be, well, misleading. He realized, gotta look beyond the surface, dig into that underlying business.
Can't just blindly follow the crowd or those exciting stories.
Exactly, gotta have that solid foundation, how to assess the real value regardless of the mood swings. Which brings us to Northern Pipeline Co.
Yeah, that one shows a different side of Graham, right? Not about dodging a bad investment, but finding hidden value everyone else missed.
1925. Northern Pipeline stock, it's trading low. But Graham, he wasn't satisfied. He dug deeper, went through reports filed with the Interstate Commerce Commission.
Wait, he's doing his own research? Through government filings? That's hardcore.
That's what made him different. A true detective. And what he finds, fascinating. Northern Pipeline's holding bonds, worth way more than their stock price.
So the market was undervaluing them.
Totally. Market's focused on current performance. Graham sees potential, buys the stock, pushes for higher dividends, waits. 3 years later, investment more than doubles.
Wow. It wasn't just luck.
Nope. Meticulous research, independent thinking, courage to act when others didn't see it. That's intelligent investing.
Okay, I see the pattern. It's not about the crowd, the hype, or timing the market. It's homework, thinking for yourself, finding that value.
Exactly. This leads us to the core, those core principles, outlined in The Intelligent Investor. They're just as relevant now as they were back then.
And those principles are not just some theory, right? They came from his experience. Savold Tire, Northern Pipeline, all of that.
Oh, absolutely. Not just stories, but lessons learned, shaped his whole approach.
So let's dive in to these core principles. Zweig's intro, it summarizes them really well.
He does. It'll resonate with you, you wanting to understand the why behind it all, ready to unlock those secrets.
Absolutely. Let's do this.
All right. Principle 1. A stock represents ownership in a business, not just, a ticker symbol.
That sounds simple, but what does it mean for the investor, really?
Think of it this way. You buy a stock, you're not just betting on a price going up or down, you're becoming a part owner of a real company with assets, operations, potential for growth, everything.
It's like buying a piece of the business, not just a piece of paper.
Exactly. It's a mindset shift. Focus on understanding that business, its financials, its competition, its long-term prospects, the whole picture.
So not getting caught up in the daily ups and downs or trying to time the market. It's about the long game and the real value of that business.
Precisely. Which takes us to principle 2. It builds on that long-term thinking. The market's like a pendulum, swinging between, irrational exuberance and totally unjustified pessimism.
Okay, picture a pendulum swinging back and forth. What's that got to do with investing?
Okay, think of it like this. Sometimes the market, it gets way too optimistic. Prices go crazy high, unsustainable, like the dot-com bubble, remember? Other times, it's super pessimistic. Prices crash, bargains everywhere, like in 2008.
So the market is driven by emotions, fear, greed. Creates those swings.
You got it. But here's the thing. The intelligent investor knows these swings happen, but they don't get swept up in it. They stay grounded, long-term focus, and they look for those opportunities. Buy when everyone's scared, sell when everyone's greedy.
Easier said than done, right?
Yeah.
It takes guts to go against the flow.
It does. But the intelligent investor, they're not trying to predict every little move. They're just taking advantage of those swings. Buy low, sell high. Simple.
It all makes sense, but putting it into practice when prices are soaring or crashing, that's tough.
I hear you. It's human nature to get caught up in the excitement or the fear. That's why Graham's principles are so valuable. It's a framework, for rational decisions, even when the market's losing it.
Like a compass to guide you through that storm.
Exactly. And speaking of storms, Graham's next principle is about protection, building a buffer against, well, the unexpected.
You're talking about the margin of safety.
You got it. One of Graham's big ideas. It's the difference between a company's intrinsic value, what it's truly worth, and its market price, what you gotta pay.
The bigger the difference, the bigger the margin of safety.
Right. A big margin reduces your risk. It's a cushion. Protects you if your analysis was off or, something happens you didn't see coming.
I'm liking this. But how do you actually figure out this margin?
That's where the research comes in. Remember what we talked about. You got to dig into those financials, analyze the industry, check out the management team, estimate those future earnings.
So it's not just finding a stock with a low price.
Nope. A low price doesn't mean good value. Got to understand why it's low and if it makes sense.
Like with Northern Pipeline. He didn't just buy because it was cheap. He did his homework, found out it was undervalued.
Bingo. He saw that margin of safety, that gap between real worth and market price, and he jumped on it. And this brings us to, I'd say, his most important principle. It ties everything together.
Okay, got me hooked. What is it?
Might surprise you. It's not about the market. It's about you. Your behavior matters more than the investments.
You mean it's not just about picking the right stocks. It's about me, my decisions, my emotions.
Exactly. The biggest threat to your money isn't the market. It's you. Think about it. Investors, they get caught up in the hype, right? Buying high, selling low, driven by fear or, well, greed.
Guilty as charged. It's hard to stay calm when everyone's freaking out or celebrating.
It is. That's why Graham stresses discipline, patience, controlling those emotions. That's how you stick to the plan, ride out the storms, avoid those impulsive moves that mess up your goals.
This is clicking with me. I see how it all works together. Understanding the business, analyzing the market, finding value, and then managing myself so I can grab the opportunities without getting lost in the emotional roller coaster.
You got it. And that's what makes Graham's approach so powerful. Those principles, they last. They're rooted in how people think, how markets work.
Okay, we've laid down the foundation, but something tells me we're just getting started. Where do we go from here?
We've got the basics. Now let's explore how Graham tackled this age-old question. How do you tell investing from speculating? Because he was serious about that line. It's amazing, this difference, it matters even more today. We're bombarded, right? Information, tips, trends, everyone's promising to make you rich quick.
It's true. Everywhere you turn, someone's got the secret formula to, beat the market. It's a lot, especially if you're just starting out.
It is. And that's where Graham's focus on this difference, investing versus speculating, it's crucial. It's the mindset, the approach, how much risk you can handle.
Let's break it down. What did Graham actually mean by speculation? Was he totally against any risk?
Not really. He knew risk is part of it, any investment. The key was how you approach it, the analysis. Investing, for him, it was research, digging deep into a company, understanding that intrinsic value, and then buying with a margin of safety.
Like we said before, you become a part owner, not just playing with a ticker symbol.
Exactly. The intelligent investor is a detective, putting the pieces together, figuring out what the company's truly worth. Speculation. It's more like gambling. Rumors, hunches, that get-rich-quick dream.
So speculators, they're watching the price. Investors are watching the value.
You got it. And Graham's got some great examples in the book showing how dangerous it is to mix those up. The foolish four system, remember that?
Oh, yeah. Late 90s, right?
Mm-hmm.
Right when the dot-com bubble was happening.
Perfect example. Speculation pretending to be investing. It was picking 5 Dow stocks, the ones with the lowest priced earnings, highest dividends.
Sounds pretty straightforward, even for a newbie like me. What was the problem?
It had zero basis in, sound investing, ignored the actual businesses, their financials, their future, everything.
Just a formula people followed blindly, hoping to get rich.
You got it. And it worked for a while, as long as the market went up. But Zweig points out it was built on sand when the bubble burst. 2000. The foolish four, gone. Investors lost big.
Like building a house on a shaky foundation. Looks good till it all falls apart.
Perfect analogy. That's Graham's warning. A strategy built on luck, on hype, it can't last. Real investing, it needs that foundation. Knowledge, analysis, discipline, the whole package.
This makes me think of market timing. Trying to get in and out at the perfect moment, that's speculation too, right?
Absolutely. Graham, he wasn't a fan of market timing, trying to predict, when to buy and sell based on, a few days a week. He said it can't be done consistently.
I've heard that, but it's tempting. All those experts making predictions, it's hard to resist.
I know. Feels like we can outsmart the market. But even the pros, they're terrible at predicting those short-term moves.
There's a story in the book about this, right? Something about a market analysis from back in '64.
Yeah. Analysts back then, they were predicting doom and gloom. Stocks were going to crash. Bonds were the safe bet.
So what happened? Crash.
Nope. Opposite. Market did great those next few years. And get this, bonds did even better than stocks. It shows even the experts, they can be totally wrong.
So what's the lesson?
Trying to time the market. Waste of time. Focus on what you can control, your process, your behavior.
So instead of timing, find those undervalued companies, the ones with a good future.
Exactly. That's where the margin of safety comes in again. Protects you from the ups and downs, even if your timing isn't perfect.
We've covered speculation, timing, being disciplined and patient. But the market, it can mess with your head. How do you stay calm, make good choices when everyone else is, panicking?
That's where Mr. Market comes in. One of Graham's best ideas helps us understand, the psychology of investing.
Oh, yeah, right. It's like the market's a moody person, always tempting you to make bad moves.
Mr. Market, unpredictable guy. Shows up every day, wants to buy or sell your stocks, prices all over the place based on his mood.
One day he's euphoric, prices sky high. Next day he's depressed, practically giving his shares away.
Exactly. And here's the genius. Graham says you don't have to play his game. You choose when to deal with him, when to ignore him.
So you don't react to every mood swing. You buy when he's down, sell when he's up.
Precisely. The intelligent investor uses Mr. Market, not the other way around. They use his irrationality to their advantage. Bargains when he's low, profits when he's high.
This is a powerful way to look at it. It's taking control, instead of letting the market control you.
It is. Back to managing your own behavior. Don't let Mr. Market's moods run the show. Make your own decisions. Logic, analysis, knowing the real value.
Okay, I see how the pieces fit together. Understand the business, be patient, no speculation, don't let Mr. Market run your life. But how do you actually find that value in the market?
That's the big question, right? Luckily, you've given us a great tool. The interpretation of financial statements. Graham's own book, you included it. Smart move.
Figure to be the perfect partner to the intelligent investor.
It is. Can't understand a business without understanding its financials. Think of them like the language of business. They tell you the story, performance, assets, liabilities, profits, the whole 9 yards.
Like reading the company's biography.
You got it. But just like a good biography, you got to read between the lines. Look for those hidden clues, the real character of the company.
I remember Graham was skeptical about those earnings projections.
He was. Rightfully so. They're just projections, right? Based on guesses about the future, which are, often wrong.
So you can't just take their word for it when they say they're going to grow like crazy.
Nope. The intelligent investor, they look at what the company's done. The financials tell that story. Revenue, earnings, cash flow. That's how you see if it's a profitable, sustainable business.
But financials, they can be intimidating. Even if you know some basic accounting, where do you even start?
That's why Graham's book on financial statements is so good. He breaks it down. The balance sheet, income statement, cash flow statement. Explains it simply.
Like a roadmap for these complex documents.
Exactly. Teaches you to read between the lines, spot those trends, figure out how healthy the company really is.
So what are some key things an intelligent investor, what should they be looking for in those financials?
Well, Graham had a few key areas. First, profitability. Are they making money consistently? Is their profit margin going up or down?
Profitability, got it. What else?
Financial strength. How much debt do they have? Can they pay their bills? Short-term, long-term. That tells you if they can handle tough times, keep running smoothly.
So not drowning in debt, able to pay the bills. Makes sense. Anything else?
Asset value. What are their tangible assets actually worth? Property, equipment, intellectual property, all that. Gives you an idea of a company's real worth, even if earnings are down temporarily.
Like searching for hidden treasures on the balance sheet?
You got it. You're figuring out the intrinsic value, what it's really worth. Might not be reflected in the stock price right now.
Back to that margin of safety again.
Exactly. Analyzing the financials, you get the evidence. Is this company undervalued? That's where you find your margin of safety, protection from those potential losses.
This is all making sense. But even with Graham's help, financials are a lot of work.
They are. Not everyone has the time, the interest to become a financial detective. That's why Graham said there are different types of investors, different levels of involvement, different risk tolerance.
He talked about the defensive investor and the enterprising investor, right?
That's right. He uses the example of a prosperous doctor. Busy, successful, wants to invest wisely, but no time to become a Wall Street guru.
Sounds familiar.
Yeah.
So what's a busy professional supposed to do?
That's where the defensive investor comes in. They want simple, low maintenance, not spending hours on financials or picking individual stocks.
So more of a passive hands-off approach.
Exactly. And Graham's recommendations for them. Funny enough, they line up perfectly with a modern strategy that's gotten super popular: index funds.
Wow, really? So even though index funds didn't exist back then, his principles actually support this modern approach.
They do. Index funds, they're all about diversification, long-term thinking, minimizing costs. Those are all core Graham principles.
Okay, so how do index funds work? And how do they tie into Graham's philosophy?
An index fund, it's basically a basket of stocks. It tracks a specific index, like, say, the S&P 500. Instead of picking stocks, you're buying a piece of the whole market.
So you're spreading your bets.
Exactly. Diversification, that's a big Graham principle. Spreading your investments across different industries, companies, it reduces your risk, increases your chance of success.
Don't put all your eggs in one basket.
Right. Index funds do that automatically. Instant diversification, one investment. Plus, they're cheap. Passively managed, just tracking the index, so fees are way lower than those actively managed funds.
And Graham was big on minimizing costs, right? Fees eat into your returns.
Absolutely. Every dollar in fees is a dollar not working for you. Another reason index funds fit his thinking.
Okay, so index funds are diversified, low cost, and fit that long-term mindset. But Graham also liked actively researching companies, finding those undervalued ones, right?
He did. If you've got the time, the know-how, the interest, it's still a valid approach. But he knew not everyone can be an active stock picker.
So index funds, they're good for the defensive investor who wants simple, low maintenance and still aligns with Graham's ideas.
Exactly. It's fascinating how his wisdom, way before index funds, actually supports this modern approach, shows how timeless his principles are.
I see the appeal, especially for someone like me still learning the ropes.
Mm.
What about the more active investor, the one who wants to dig deeper, maybe beat the market?
That's where the enterprising investor comes in. Remember that, doctor? Say they're actually into finance, have some free time to research companies.
Willing to roll up their sleeves, do the work.
Exactly. That's an enterprising investor. They don't just want to match the market. They want to beat it. Finding those undervalued companies, those special situations.
Okay, so how do they find those hidden gems?
Starts the same way we've been talking about. Thorough research, analyze the financials, focus on value, not price. But they take it further. They go against the crowd, look in unusual places, dig deeper.
Sounds exciting, but kind of scary.
It can be. Graham was clear, this isn't for everyone. You need expertise, high risk tolerance, and lots of patience. But if you put in the work, it can be amazing.
Like the difference between a casual hiker and a mountain climber. Both enjoy the outdoors, but the climber wants that challenge, that bigger reward.
Great analogy. And just like the climber needs skills, equipment, the enterprising investor needs to understand the markets, have those analytical tools, and control their emotions when things get tough.
Okay, so we've got the defensive investor, maybe using index funds, and the enterprising investor, maybe researching individual companies. But even then, there's lots of different approaches, right?
Absolutely. Investing isn't one size fits all. You need to find what fits you. Your goals, your risk tolerance, how long you're investing for. And that brings us back to knowing yourself, your strengths, your weaknesses.
So self-awareness is key.
It is. Graham was clear, the most important factor isn't the market, it's you. Your behavior, your discipline, controlling those emotions, that's how you reach your goals.
I'm getting it. It's not just the right stocks or the right strategy. It's the right mindset, the right habits.
Exactly. That's why the intelligent investor is more than just stock picking. It's about the mental game, the emotional skills, to succeed in the market no matter your approach.
Like a mental training manual for investors.
Exactly. And even though it's from decades ago, his insights into how people think, how markets behave, they're still relevant today.
This has been an incredible journey. We've covered those core principles, speculation versus investing, the whole Mr. Market thing, understanding financials, plus how Graham's ideas apply to modern stuff, like index funds.
It's amazing how much we've covered, and there's still more.
I know. But before we move on, I want to go back to something you said. Graham recognized different types of investors. He even had a whole chapter on investment funds, right?
He did. And this is a topic I think it's really relevant today with all the mutual funds, ETFs, all those choices investors have now.
So even though he was writing back in the 70s, his thoughts on funds still apply.
Absolutely. And it's super valuable because there are just so many options now. Back then, it was simpler. Fewer funds, and most were actively managed.
Actively managed, meaning there's a team picking stocks, trying to beat the market.
That's it. And Graham, he had some strong opinions about that. Skeptical of funds chasing short-term performance or the latest hot stocks. He thought that meant lots of trading, high costs, eating into returns.
So those fees, the constant trading, bad for long-term success.
He thought so. And he argued that style, that active management, it encouraged speculation. People focused on those price jumps, not the real value of the businesses.
So what was the alternative?
He liked a more conservative approach. Find undervalued companies, good fundamentals, hold them for the long haul. That approach, plus low expenses, patience, discipline, that's the key to consistent returns.
Sounds a lot like his philosophy for individual investors. Value, margin of safety, patience.
It is. And his perspective on funds, it matters even more now because we have this whole new category that aligns perfectly with him, index funds.
Right. Those index funds, they're passively managed, just track the index, and those fees are usually way lower.
Exactly. I think Graham would love them. Diversification, low cost, long-term focus, it's all there.
So for the defensive investor, index funds are a good way to build a portfolio without picking stocks or worrying about timing the market.
They can be. And this is what some of the most successful investors recommend, including Warren Buffett, who learned from Graham.
Okay, I'm convinced about index funds. What about the enterprising investor, the one doing all that research? Any advice for them on funds?
There is. He didn't love most actively managed funds, but he knew there could be exceptions. A skilled manager who really gets value investing, low turnover, they could beat the market long term.
So it's possible for active funds to win, but it's tough. You need to find that exceptional manager.
Exactly. And even for the enterprising investor, Graham said, choose carefully. Look at their philosophy, their expenses, their track record. Avoid those that chase performance, take big risks, or charge high fees.
So even with funds, same principles apply. Look for value, assess the risk, be patient.
Exactly. Index funds, actively managed funds, individual stocks, it doesn't matter. You need to know your own goals, your risk tolerance, your time horizon.
This is so helpful.
Yeah.
But even the smartest investors, they mess up sometimes. How do you handle those mistakes, the setbacks that happen?
Great question. Graham talked about this in the book. Investing, it's not about predicting perfectly. You'll make mistakes. The market will surprise you.
So how do you keep those mistakes from ruining your long-term plans?
Graham had some advice. First, that margin of safety.
We talked about that. How does it help here?
It's the difference between what the company is really worth and its price. It's your buffer, protects you if you're wrong, or if something unexpected happens.
So if you buy with a big margin of safety, you have room for error.
Exactly. Even if the company doesn't do as well as you thought or the market drops, you're less likely to lose big.
Okay, that makes sense. What else did he say about mistakes?
Learn from them. Don't ignore them. Figure out what went wrong. Was your analysis bad? Did you miss something?
Turn those mistakes into learning experiences.
Exactly. Every mistake, it's a chance to improve your process, sharpen your skills, become a better investor.
This is great. Mistakes happen, but it's how you react that matters.
Precisely. And that leads us to another crucial part of Graham's philosophy: emotional control.
We touched on this, but it's worth repeating. How do you stay calm, especially when the market's going haywire?
Graham said the key is having a clear investment philosophy, principles that guide your choices.
Like a roadmap to keep you on track when things get bumpy.
Exactly. And that's where value investing shines. You focus on value, the business itself. You don't get swept up in the market's emotional swings.
You're thinking long-term about how the company will earn money, create value over time.
Precisely. Daily price changes, headlines, they don't matter as much. It's the big picture.
Back to Mr. Market. The intelligent investor doesn't let his mood swings call the shots. They use logic, analysis.
You got it. And Mr. Market, he's always there, tempting you to make those emotional decisions. But you choose whether to play his game.
So you see when he's being irrational and you take advantage.
Exactly. That's why discipline, patience, emotional control, they're so important. They keep you grounded, you stick to the plan, avoid those impulsive moves that ruin your goals.
Okay, we've covered a lot. The principles of intelligent investing, the dangers of speculation, understanding financials, the importance of emotional control. Before we wrap up, there's one more topic that seems really relevant for today.
I'm listening. What is it?
We've talked about Graham's ideas for individual investors, but what about people who want professional help? How do you find an advisor who gets Graham's approach?
Another great question. Graham actually addressed this in the book. He had a whole chapter on the investor and their advisor.
So he knew finding the right partner for your investing journey is important.
He did, and he had specific advice on choosing an advisor who fits your investing style and who puts your interests first.
I'm all ears. What should you look for?
First and foremost, honesty, competence, experience. Someone who understands your goals, how much risk you can handle, how long you're investing for.
So it's more than just a fancy resume.
More than that, credentials matter, but you got to trust them. They got to communicate clearly, genuinely want to help you reach your goals.
Like a partner, not just someone providing a service.
Exactly. Open communication is key. Ask tough questions, challenge their thinking, understand their process, don't be shy.
So it's a two-way street.
It is. Graham warned about advisors who throw jargon around, make big promises about beating the market. Remember, he was skeptical about timing the market. Any strategy based on predicting short-term moves.
So you want someone who's grounded, realistic, focused on the long term.
Exactly. Someone who gets value, margin of safety, disciplined investing, all of that.
Like Zweig said in his commentary, find an advisor who's a financial doctor, not a financial salesperson.
Perfect analogy. A good financial doctor, they'll figure out your financial health, prescribe the right investments, keep you on track for those long-term goals.
And they won't try to push the latest hot stock or fad.
Right. They'll focus on what's best for you, not on their commission.
Okay, I see how important it is to find the right advisor, someone who shares your values, understands intelligent investing.
It is. Graham had some tips on evaluating them. Ask questions like, what are your qualifications? What experience do you have? What's your investing philosophy? How do you pick investments? What happens when an investment does poorly?
Those are great questions. You really get to see how they think.
You do. It's your financial future, so don't be afraid to be thorough.
Graham also said to watch out for conflicts of interest.
Definitely. Advisors who get paid to recommend certain investments, even if those aren't good for you.
So how do they get paid? Flat fee, commissions, transparency is key.
Exactly. You want someone who's open about their fees, explains their recommendations clearly so you understand.
This is so helpful. This deep dive into Graham's wisdom has been amazing. We've covered so much. The basics of intelligent investing to finding the right advisor.
It's been incredible, and I hope our listener is seeing how relevant Graham's principles still are, even though the market's always changing.
Me too.
Yeah.
But before we go to the final part, I want to leave our listener with a question.
I always love that. What is it this time?
Think about everything we've talked about. Value, margin of safety, emotional control, finding the right advisor. Now ask yourself, where can you apply Graham's teachings in your investing?
That's a great challenge, yeah. It's not just listening, right? It's about doing something with it for your own situation.
And that's pure Graham. Giving investors that power, control of their own money, think for themselves, use logic, reason, not get swept up in, emotions and hype.
One of the biggest mistakes, I see it all the time, it's performance chasing. Buying stocks just because they went up, selling because they went down.
Like trying to jump on a train that's already left, you're always behind, buying high, selling low. The worst.
Exactly. Recipe for disaster. Past performance, it doesn't guarantee anything for the future. It can even trick you.
So how do you avoid that trap?
Focus on value, not just the price. One of Graham's biggest lessons. Essential if you want to invest well.
Okay, break that down. Value versus price. What's the difference?
The price. That's just what people are willing to pay right now. Changes all the time, driven by, emotions, speculation, short-term trends. Value, that's tied to the actual business. What are its assets worth? How much money can it make? What's its future potential?
So you're looking past the daily ups and downs at what the company's really worth.
Exactly. Like a detective, right? You're finding those clues. What's its real value? And can't be afraid to be different. Buy when others sell, sell when they buy.
That takes guts. When the market's saying one thing, but your analysis says something else.
It does. But remember, Graham said the market, it's not always right. Sometimes prices are way off from the real value, and that's when the intelligent investor can jump in.
Patience to wait for those moments and the, what's the word, discipline to step your guns even when the market's messing with you.
Exactly. Which brings us back to Mr. Market.
Ah, yes. Mr. Market.
Yeah.
Always there, tempting you to make a bad move.
Remember, he's all about emotion, fear, greed, optimism, pessimism, all those mood swings. That's what creates opportunities.
So how do you handle him? How do you not get caught up in his drama?
You gotta remember, he's not always thinking straight. Those prices he throws out, they don't always match reality. Sometimes he's too happy, prices too high. Other times, he's down in the dumps. Bargains everywhere.
So Mr. Market, he's like a source of opportunities. You don't just follow him blindly.
Exactly. Use his craziness to your advantage. Buy when he's scared, sell when he's excited.
This reminds me of something Buffett said. Graham's star student, right? He said he likes to be fearful when others are greedy and greedy when others are fearful.
Great quote. That's Graham's approach in a nutshell. Think for yourself. Don't let the crowd control you.
Be a contrarian. Don't follow the herd. That's how you get those bubbles and crashes.
Exactly. The intelligent investor, they're willing to be different, make their own choices, based on logic, not hype.
Okay, we've covered the principles, emotional control, all that. But let's get practical. What can our listener do with their own portfolio? What are some actual steps?
Good question. First step, figure out what kind of investor you are. Are you more defensive, simple, low maintenance, or enterprising? Ready to dig in, research individual companies.
Once you know that, you can start building that portfolio.
Yeah.
Matches your goals, your risk, your time horizon, all that.
Right. No one right answer for everyone.
Find what works for you and stick with it.
Exactly. Discipline and patience, that's key. The intelligent investor, they don't sweat the small stuff, the daily ups and downs. They're playing the long game, building wealth slowly, steadily.
And that's where the margin of safety comes in.
Right.
Helps you through those rough patches, protects you from those big mistakes.
Like a shock absorber.
Mm-hmm.
Keeps you on the road, moving towards those goals.
This deep dive into the intelligent investor, it's been incredible. Graham's principles, market psychology, how to build a winning portfolio, it's all been so valuable.
It has, and I hope our listener, they got something out of it too.
And remember, if you want to go even deeper, explore more of Graham's work, the expert here is happy to answer any questions.
Absolutely. We're always here to help you become a smarter, more intelligent investor.
That's it for this episode of The Deep Dive. Thanks for joining us.